This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we are very pleased to welcome on guests from Tempest 22, a private equity firm that specializes in investing in a kind of commercial real estate that we haven't really covered before, and that is hotels, something near and dear to my heart and something I think you will find very interesting, so make sure you stick around for that. But today on the download, big news out of the whole FTX debacle. Sam Bankman-Fried, the embattled former CEO, has finally been arrested in the Bahamas in connection with the catastrophic collapse of FTX and Alameda Research. This has been something that has been definitely not something that we did not anticipate seeing, but I do think it is taking a little bit longer than expected to actually have happened. So it'll be interesting to see exactly how the indictment and liquidation plays out, but we will start seeing the court dates start being lined up and everything else like that. Some other interesting factors are the liquidation of the assets that are being held by FTX, so many of them being held in the Bahamas, that there is some concern coming out that Bahamians, especially those Bahamians that were affected by the fraud, might be getting paid out at a schedule that is not in line with how typical liquidations of these types of companies go. So that's some other kind of rumblings coming out of this, but it'll, again, this is going to be a very long, convoluted, and protracted process that is going to be over in no short order. So we will keep bringing you updates as they come along. But again, SBF finally being arrested is very big news out of that. Now, another interesting thing that we are seeing right now with regard to technology is the potential to have the social media company TikTok banned in the United States. Now, this, unlike many other social media companies, is not a US or European social media company, but it is a Chinese-based social media company. And there are concerns over national security of having so many U.S. users and personal information and smartphones being vulnerable to this software, that there is bipartisan legislation being introduced that would effectively ban this app from being used on app stores and on phones in the United States by American citizens. This is interesting in and of its own right, as there was a push to do this during the Trump administration that got blocked in court, but this is being championed by Marco Rubio out of Florida and does have bipartisan support of both Democrats and Republicans in the House and Senate. So it'll be interesting to see where this goes. Now, the more interesting part about this with regard to financial markets is the fact that this might have the potential to really take out one of the largest competitors to some of the US-based social media platforms, such as Snapchat and Meta, which is the company that owns Facebook and Instagram. All three have been seeing their market share get decimated by TikTok over the past few years. So if TikTok is banned, it would wager to reason that these other companies might see a significant improvement in their share price if this actually does come about. Again, it's going to be very interesting to see. Will it actually happen? Won't it? I really have no idea. I thought it was kind of a bit hyperbolic when the previous administration was saying that they were going to do it, but I guess the sentiment still is there, with many people wanting to have some type of resolution on this particular issue. So we will see where this actually goes in the coming weeks. Tesla is seeing its price to earning ratio slide to its lowest level since 2020, with decreased demand in China and inflation really being what is the biggest factors to blame in their price to earnings ratio. And this has caused its market value to dip below $500 billion, which is the first time that has been the case since 2019. So auto manufacturer giant Tesla definitely in a little bit of hot water right now, also starting to see its share price slide as well. So it'll be interesting to see where exactly that plays out. And lastly, on the download today, we have something kind of interesting out of the video game sector, which I haven't reported on recently, which has caused Sony America's shares to rise fairly rapidly. The video game giant Activision was acquired by Microsoft earlier this year, which was widely seen as a good move for the tech giant. However, it does cause some issues and some potential antitrust and some potential antitrust issues for the company, as Activision is the publisher of the video game franchise Call of Duty, which is hugely popular, but it would have given them essentially too much of a direct market share in closed systems. So there were several lawsuits, which has come. So the point of this being is that Microsoft has now opened up the Activision, I should say, Activision, by the direction of Microsoft, has now opened up Call of Duty for at least its App Store downloads to be onto other platform services such as Sony and other video game app stores. So this has caused Sony's share price to rise almost 2% trading on the day, today being Tuesday, December 13th. So something pretty interesting to look at right there. I just thought it was kind of interesting that you would see something like a video game causing a multinational corporation's share price to rise when it wasn't even the one that published the video game. Just something, you kind of come across doing some research on these things that I think is pretty interesting. This has been The Download. Today on the what is a price to earning ratio? I figure in the download, if I mention Tesla's sliding price to earning ratio, I should probably define what that is for people who are curious. Price to earnings ratio is the ratio for valuing a company that measures its current share price relative to its earnings per share. The price to earnings ratio is also sometimes known as the price multiple or earnings multiple. Profit and earning ratios. Price to earning ratios are used by investors and analysts to determine the relative value of a company's shares in an apples to apples comparison. It can also be used to compare a company against its own historical record or compare aggregate markets against one another over time. This has been the What Is. Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we are pleased to welcome on Octavio and Danny from Tempest 22, and we're going to be talking about some pretty interesting stuff when it comes to investing in commercial real estate. We've covered everything from assisted living facilities to car washes to self-storage to apartment buildings and everything in between. But one thing in commercial real estate that we haven't really covered, besides maybe industrial real estate, is hotels. And it's something near and dear to my heart. My wife has been in the hotel industry and hotel management and in different parts of the industry for a better part of 11 years now. So it's going to be really interesting to kind of dive in and see, what exactly it takes to invest in hotels, what some strategies are behind it. So I'll let the guests give a brief introduction of themselves, and we'll kind of go from there. So Danny and Octavio, tell us a little bit about yourselves.
Yeah, sure. Thank you so much, Alex, for having us on the show. Everybody, my name is Danny Frye, and I'm a retired 20-year retired veteran from the Army, 8 years as a combat engineer, mostly in the 82nd Airborne Division. And, the rest of the time was in special operations with a focus in the Pacific, Pacific region, and, with a focus in strategic governance, civics, and humanities. Moving out of the, retiring out of the military. Well, the military has a way of making everybody a real estate investor, right? So my wife and I bought our first house in 2009, and 8 months later, we were real estate investors because they told me, hey, it's time to go to Texas. And I didn't see the house again for 8 months. So if we'd sold it, we'd have been $20,000-$30,000 in the negative. So, we held it. 5 years later, we had about 3 weeks worth of vacancy, and the house had been paid off substantially. We'd made some pretty substantial cash flow, and kind of caught the bug from there. So moving out of the military, I jumped right into real estate sales, opened up an investing company to do flips with my brother-in-law, and just the natural progression of a real estate investor, going from, residential typically into multifamily, where about 95% of people move into. I didn't really want to do that because there was so much saturation. We saw about 95% of the people moving into that space. I started looking into office really. And, fortunately, before I dug too deep into office and flex space, I met my business partner, David. But before we get into all that, I'd like to, turn it over to Octavio, man, because I'll just keep going.
Yeah. Hey, thanks, Danny. Yeah. So I served, my name is Octavio Mota. I served 14 years in the military between Air Force enlisted and Army officer. I had a phenomenal time and honestly would have kept on going, but unfortunately there was a series of injuries that made the decision, easier for me because, I would have, it was a tough one at the beginning. I didn't want to go, but through medical advice, and family advice, it's kind of why I decided to go on. But that was or transition, right? But how it applies to a lot of from a personal standpoint, a lot of the skills and preparation and training that I received from that, I carried that over to real estate, right? And it was very early on that I learned how to conduct what it is in terms of real estate investing. I started off with one trailer, then moved on to another, bought a triplex after selling both of those, started doing some single family homes, did flipping, learned other businesses. And again, it's because of some of the same background and training and everything that I have from the military. I was carrying it over and using those same skills into this industry. And before I know it, I was in a small and large multifamily, and that continued to grow. And then I started opening up other successful businesses and partnering up with individuals because, again, like, I keep alluding back to the military, you learn real quick, you got to do things like a team, right? If you want to go fast, go alone. You want to go far, go together. And military teaches you a team mentality in order to complete the mission. So I applied that with other businesses that I started owning, developing the right team, partnering with the right individuals, and carrying the same mentality of wanting to continue to grow and continue to grow, create wealth, right? Well, it's funny. That's kind of where I met Danny. I realized, the market cycle and where it was at and where we were going. And I was noticing, quite frankly, the deals just weren't as prevalent or as good, on the multifamily side. And I wasn't willing to take down a deal for my investors if I knew it was a bad deal going in. Unfortunately, we'll see some of that in the next upcoming years, right? Of those individuals that were either new money, new business, or just didn't really have a quite understanding of the market cycles and how they work. So that's when I started looking for the next best vehicle, and all of a sudden Danny came along, almost like as like the movies would portray, on a white horse along the beach, just traveling along. Hey, I got the best vehicle for you. Hop along, jump on. So he was able to quickly relay what the hospitality management industry is doing across the nation, and I just couldn't believe the numbers, right? And it wasn't until I started peeling back the onion and started looking deep into the financials and deep into the hotel, like all the hoteliers, to include David Stahl, which Danny just alluded to earlier, that I noticed this was the best vehicle. This was the next vehicle that we should jump on. So that's kind of a little bit about me.
Awesome. Well, thank you very much. I can say with a high degree of confidence I think we're getting up into almost the 60th edition of this podcast that I've done. I think I might have had maybe one or two veterans on before. So again, thank you for your service. And it's awesome to always be able to talk to people who had served our country, and now we're getting the foray into the investing realm of things. So it's always cool to have you all on here. Yeah. So let me let's just kind of give a little bit of a definition for people, because I think so much of the time, I've been basically living out of a hotel for the past 2 weeks of my life. I'm a big fan of Marriott, like to stay at their properties. What most people don't understand is that, when you drive down the road and you see a Marriott or a Hilton or, an IHG or an Intercontinental, these companies, while they do have their brands stuck on the side of a building, these are not just like corporately owned sticks that are sticking out there. More often than not, I mean, granted, there are corporately owned locations, where Marriott International does own that property, but a lot of times it's just management groups, and it's different conglomerations of people, and it has a lot of like parallels to kind of the limited partner commercial real estate space, where you have a group of people that come together and own different blocks of hotels. For example, and I'm not going to say the name since it's very local to where we're at, but there's a large hotel down here that's owned by a conglomerate of people. They have several down in West Palm Beach. They have some here in Pinellas County. But although it does have a certain placard on the wall of the building, the paycheck comes through and it is XYZ management company that owns these different blocks of hotels. So I think that's good to kind of for people to understand in general. Again, that's very high level of how hotels work. Is that, you know, a lot of times these companies will kind of more or less rent out or license their name to certain properties, and obviously it helps with them with generating additional revenue, marketing, getting into their booking systems, things like that. So just again, high level, you know, for people to understand kind of maybe how someone could get into this, because what y'all are doing is not necessarily saying, well, yeah, we're going to go out and build hotels from the ground up, because that would be, you know, extremely capital intensive to say, okay, we're getting into hotels, we're going to go build a bunch of independently branded hotels, which, you know, certainly buying independence probably has its own, you know, provenance and, you know, path forward to doing that. But, you know, I just don't think a lot of people know that. I certainly did it when my wife started working in hotels of, you know, that's how a lot of the industry works. So maybe, you know, with that kind of said, how do hotels as an investment kind of work? You know, in general, if I was going to say, hey, you know, I want to go buy a hotel, what is that kind of, you know, or maybe even actually, you know, I think a better way to do that, you know, for how y'all got into it, you know, you both said that you kind of got in, you know, just like any real estate investor, you know, after you got out of the military, okay, I bought a piece of residential real estate. Octavio, you bought some trailers, which I love mobile homes. Those things are fantastic. They basically print money.
And, 100%.
You know, and Danny, you got into some of the single family stuff, but obviously, you know, a lot of people see, you know, the throughput, you know, it's you get X amount of input in for a certain amount of, you know, throughput out, and the amount of effort that you have to put into commercial real estate is not a whole lot different than the amount of effort you put into, you know, just call it the single family bucket, but you get so much more out on the back end. So, you know, obviously you kind of had the same path forward, but then, you know, you saw hotels as a benefit. So kind of explain maybe what it took to kind of, you know, initially get your stab and start into that. What does that look like from the initial transition? You know, what are some things that, you know, you kind of saw along the way, and then kind of what pushed you into that? And then we'll kind of get on to some of the tertiary stuff of, you know, maybe the structures of what y'all went with, what you learned along the way, how you developed your systems to kind of make it a profitable endeavor for you and your investors.
Yeah, absolutely. Thanks a lot, Alex. So, you know, hotels, I mean, it boiled down to meeting the right people. So, you know, as Octavio, you know, mentioned before, the team is really what makes, you know, syndications and this type of investing so fantastic, is that you identify who has the skill set, right? Not just the skill set, the right skill set to do whatever it is that needs to be done. So for us, we found ourselves as, you know, being real estate investors, especially, you know, and then having the background in, you know, strategic planning, you know, gave us a greater scope of vision for, you know, what the actual what investing would look like on a grander scale. And then we met somebody, David Stahl, that had a tremendous amount of experience in the hotel industry. And so when I met David, it was, I don't know, end of 2018, early 2019. You know, David had saw that I was a real estate investor. I had just come back from a syndication seminar, and, you know, it was just like the right time. And, you know, so David explained to me that, you know, basically, you know, there's a large majority of a large portion of hotels that are underperforming their potential. They're profitable, right? But they're underperforming what their potential is. And, you know, kind of went through exactly what that opportunity's like, and this is pre-COVID, you know, so he's, you know, we basically broke it down and created a business structure around it that benefited, you know, where I could bring investors in. He would run the, you know, the operation, and I would manage the investors, and you know, we'd make it a profitable venture. What it boiled down to was that, you know, you really had three reasons why hotels were failing. One of them had to do with location. Oh, you can't really do anything about that. So, you know, we pass on that situation. Then it came down to customer experience. So, you know, which is a combination of the, you know, customer service and the condition of the hotel. And then lastly, it would have been in revenue management. So all of these are, you know, boiled down to the majority of the problem was in the managerial aspect, in the management of that asset. So, you know, David understanding, you know, and becoming an expert manager of hotels knew exactly how to address those concerns and bring them back to a peak performance, stabilize it, and then be able to exit. So the opportunity was already there pre-COVID, and then COVID just exasperated it by, basically flooding the market with, you know, distressed assets. It really challenged, uh, you know, the average operator, marginal operators, right, that were doing well. It really challenged their limits, right? And so it flooded the market with opportunity of people that were having to sell at a discounted rate.
Yeah, and Danny or Alex, if I can add, right? So a biggest thing is like a lot of individuals, what you heard there was experience, right? What's very interesting about this industry is that it is a high barrier entry, right? I tell people it's like a double-edged sword, a lot of people don't know that the hotel industry, like to get a flag, right? Or to be a hotelier, you need experience, but you can't get experience without owning a hotel. So how do you do it, right? And most of these hoteliers start from the ground up, right? David, 25 years plus of experience, started from the ground up, and you'll see that very common, right? They started maybe in the laundry room like David did and worked their way up to management and then became a generational hotelier, right? So that's what's great, right? Is that those individuals identify that they'll start running out of capital, right, relatively soon if they start putting up their own. So what they do is they pursue organizations like Tempest 22 and say, hey, look, I have the blueprints, I have the understanding, I have all the experience. What I'm missing is asset managers or individuals that can help raise capital to fulfill that requirement. And that's where we came in, right? It's like, hey, we have all the investment experience, we have all the knowledge and back end, support to include resources like syndication, real estate syndication, law firms, or business tax and legal advisors. We have all of that, right? So we became each other's missing link, right? You become the hotelier, we become your asset manager, and with our investors, we become great stewards of everyone's capitals or investors' capital, and we take down these value-add hotels. So we lowered the barrier entry on an asset that had a very high entry to get into. Yeah.
Yeah, absolutely. And I think that's a big thing, especially with hotels where, you can kind of supplant a lot of the information that you learn from managing single family properties. If you manage 15 single family properties, I mean, you understand, a tenant, needing a toilet or a water heater and stuff like that. And it's not easy. It's not that hard to scale by saying, okay, well, now I'm getting into commercial multifamily. Great. It's basically just an economy of scale bigger, but it's not too much different. You're not having to worry about like a concierge desk or, X, Y, or Z. It's a little bit easier to scale, but that's a good thing that you brought up is that there's a whole slew of like experiential items that is becoming a hotelier that's past just understanding real estate. Like you said, can't do anything about location. Yeah. Management is going to be, paradoxically different with hotels than it is commercial multifamily, but that's a big component of it. And then, the other kind of ancillary things as well. So I think that's a really good thing to point out is that, hotels, while yes, they are real estate, it's a whole different kind of, ballgame than just that. And you need to have that big experience component as opposed to someone, that just is experiencing commercial multifamily. Now, one thing that we kind of brought up in our kind of, introduction to this, which I thought was really interesting that I want you to expound on, is the difference of the market cycle that hotels are experiencing right now versus really any other type of real estate. Kind of starting with COVID, let's say beginning of 2020, there was, everything was relatively on kind of a stable market trajectory of whatever that was good, better, and different. And then we have COVID that affected different things very differently. And I didn't realize, at least when you explained to me, how much different that was for something like hotels, and why that leads into what I kind of want to get into as well, is that why that now is an opportune time to start looking at these as investments. So maybe kind of explain what that kind of, that huge cataclysm that happened in the hotel industry that really didn't have, obviously everything was affected, but that didn't have nearly the dramatic effect in other segments of commercial real estate as it did to hotels. And let's lead that into, kind of some of the investment strategy that y'all have for these.
Yeah, absolutely. So I love this part. So, I'm a big, economics and strategy nerd. So the way I read it, the way we saw it is that, look, when the pandemic happened, when it kicked off in, say, I think it was March of 2020, uh, by the third week of March, you know, the country was basically locked down. Not just the country, the world was basically locked down.
Mhm.
So, hotels were really thriving, and then immediately hit the bottom. Because occupancies went from, I mean, that was right around spring break. So it was a busy peak season, and then immediately uh occupancies dropped near 5% across the country. And those individuals that had not been through a market cycle before, were not prepared. So, that's when the hotels hit the market cycle. But other asset classes too, especially, the stock market, and cryptocurrencies were started this, rapid climb, and residential real estate, all started this massive rapid climb. We saw this huge spike right around that time. There were some social political influencers too that also drove, that drove those markets up. But what happened is, hotels stayed at the, hit the bottom while everything else was in that climb. So
Yep.
now, as we've moved forward and we're on this looming recession, all those asset classes that were thriving in 2020 are now in a decline, or driving towards their bottom of the market cycle, right? Whereas hotels are never going to see a bottom like they saw in 2020 ever again, probably, you know. And so while everything else is kind of, on that downturn, hotels are on the upturn. And so what the recession has done is, or this, this economic turmoil that we're in right now, that's causing this downturn in the market cycle. uh where hotels are at is, it has like prolonged the upturn, right? Which is the most advantageous point in a market cycle to buy. And the reason that is because it has slowed down, the growth, right? Yeah, and where people are tightening their wallets, but we're still seeing hotels at, COVID pandemic price points, and we're buying those underperforming, other market hotels that are performing at what their peak in this market cycle are. We're buying them, at COVID, at the COVID break point.
Yeah.
And at that point, we negotiate very well. So we negotiate them to a cash flow positive, and then improve them up to where the rest of the industry is within the hotel industry, with the rest of, to bring it up to that potential performance. And then, now we're going to ride this cycle all the way up to the top. So that's why it's such an advantage point in hotels versus, every other asset class. We're not anti any other asset class.
Yeah.
We are investors, and the market cycle is what we are excited about. And we just happen to be in the best advantageous position with the best asset class in the right place at the right time. Always liken it back to, and we got the right partners. And I always liken it back to, the housing market of 2008 to
Mhm.
2012. That was a incredible wave. I mean, all of us would probably go back and dump, every dime we have into residential real estate, in 2008 or 2009, knowing what we know now. Well, that's what we have in hotels. That's where we're at right now in hotels.
Yeah, and Danny, I love your clock analogy, right? So
Mhm.
Alex, like, right now everybody knows, like, in the residential and arguably even multifamily, it was January to April. It was at the 12 o'clock, right? It was all time sell, all time, get offload it, right? Because it's just perfect timing. And at the 6 o'clock, you had hospitality management, right? It was all time best time to buy, because we're still seeing ripple effects of COVID, in this industry, right? Individuals that are it's still taking them a year or two to even survive or stabilize at a price point that they can at least walk away with happy, right? And some people don't even get that, right? So now, to give that analogy of the clock that Danny uses a lot, we're, residential and multifamily, we're not against it. We want to jump on it. But organizations like Blackstone don't even, have seized, right? And we all know the why. The why is because the 12 o'clock has already passed, right? It's now going into the 3 o'clock position where, it's time to stabilize and hold on those properties. And hospitality management is going to the 6 to 9, right? You bought at the lowest price point. And then you're moving up to stabilize it and add that value and maintain that value, and then go to sell, right? In a couple of years, 3 to 5 years, is the average hold that most people are doing in this type of industry.
Gotcha. Great. Now, are most of those kind of properties, and again, this is kind of painting with a broad brush, and most of those flag property, I'll say flag properties, your Hiltons, Marriott's, IHGs, or are they independents, or is it just kind of a market in general, or is there any real kind of difference between the independents and the flag carriers?
Yeah, so it's really the market in general, and honestly, within the market there are sub-market, there are sub asset classes within the asset class of hospitality, because you do have, as in apartments and multifamily, you have class A, B, C, D, in that space, but they're not necessarily separated from their performance, right? But in hotels, you have, limited service, full service, select service, resorts, and you can kind of relate that to economy, right? And you can kind of relate that to, the A, B, C, and D, but they're on different cycles, right? They're within the same section of the cycle, but they're slightly different. So economy class, and your select service and limited service, that's really your business travel. Well, that came back before tourism did, right? Yep. So your resort class, is still, that's on a longer trajectory, right? And that one has slowed down substantially on its growth. So even though we're in the same quadrant of the clock, on the analogy of the market cycle, we're in the same quadrant of the clock, but we're not on the same time. And between each of those asset classes, so it's really doesn't matter between brand, IHG, Choice, Marriott. It doesn't really matter. It matters on what the level of qualification, or the level of class is on those hotels.
Okay. Yeah, I was kind of curious. So I know there's such a wide. I mean, I think anyone kind of understands that. I mean, there's not everything is a Ritz, and also not everything is a Motel 8. There's a huge spectrum when it comes to hotels. So it's just like there. I think I would argue to say there's a much larger spectrum in the spectrum of hotels than there is even in commercial real estate. At least apartments. I think apartments. They only go so far one way or another until you start getting into other asset classes like co-ops and condos and things like that. So just interesting things I wanted to kind of bring up. So now let's maybe transition a little bit into we've covered kind of the why, of why this asset class, where it is exactly on its, trajectory of, why this is attractive. And I think, again, that's one of the kind of the most interesting things that, was brought up just in this podcast and what we talked about earlier is just the fact that because of the nature of its business is on a different trajectory than other pieces of commercial real estate. And part of the reason I like to have this podcast is for people to understand that just because you're looking at one asset class doesn't mean that it kind of gets lumped in with every single thing else in that asset class. You talk about real estate. Okay, well, there's commercial real estate, there's individual, there's mobile homes, there's mineral rights, there's all sorts of different stuff. So just, when you think about one asset class, understand that there is different shades of gray and there's a whole spectrum on the rainbow of things you can invest in. And there's always opportunities to make money. And talking about hotels, which again, something pretty interesting. So now let's talk about investment strategy, because this is also something where it's a little bit different than, you know, what a lot of other people I've had on here are. And, you know, most of the other people that I've talked to in general are kind of the trajectory of saying, hey, you know, we have a few general partners. We have, you know, the one that's active in management. We have the money guy, and then we have, you know, 15 or 20 limited partners that come in and plug in their chunk as a limited partner for their passive income. And it goes like that. They take down the building. You know, there are some parallels to what you explained to me with that, but you do have definitely a different take on how y'all do it. So maybe explain to me, you know, how you play into the actual structuring of the investments that y'all like to do, and maybe why you think that's more advantageous than other people.
Yeah. So, absolutely. So the way we, you know, we like to structure through, you know, like a syndication, you know, private equity structuring. So, the reason that, you know, a lot of like where our passion came from, you know, our mission statement is, really to create financial independence and generational wealth for families, you know, through passive investing. And, you know, that kind of cuts out a big portion of the people when you look at the, you know, a typical private equity offering, because you've got to be an accredited investor, you've got to be wealthy, right? And that's not, you know, we wanted to be able to be inclusive to mom, you know, dad, cousin, brother, you know, military, you know, brothers and sisters, right? You know, just regular people that, you know, potentially have $20,000 or $30,000 in the bank that's just sitting there, you know, at a 0.25% interest in the savings account. And you know, we want to be able to create that cash flow and help them, educate them along the way. We want to bring them up, you know, out of the, you know, their generational cycle. And so, you know, when we looked at the structuring, you know, with you know, with our operating partner, you know, basically we get the hotel itself, you know, as an LLC. It's its own entity, the hotel is. Well, David, he's not a member of Tempest 22, but he's an owner. So he gets, you know, a portion of the hotel with his entity structure. And then our entity structure, you know, we created our own investment company within that's specific to that particular hotel, and bring in all the investors into there to, you know, collate it. So there's really one investor into the hotel, and that's that entity. And then we break, you know, we have it structured and we break it down. Now the opportunity is so grand. You know, a lot of people are, you know, probably thinking, and this is something that we do come across occasionally, is, wow, you know, that seems like there's a lot of delusion in the percentage of ownership. I'm like, yeah, but are you excited about the percentage of ownership? Or are you excited about the return? You know, if you're going to buy, you know, into Starwood, which is a hotel REIT, you know, publicly traded, you know, it's really, I believe that's Marriott, right? And, you know, if you're going to buy into that, man, you're not going to own a significant portion of Marriott, right? You're going to own a very tiny portion, but you're not excited about how much of that you're going to own. You're excited about the return that REIT's going to provide you. So we're able to, because of where we are at in the market cycle right now, everything, I won't even, you know, it won't pass our underwriting if I can't pass a minimum of 20% internal rate of return down to the limited partner, to the lowest level of the investor, 20%, because that's where the opportunity is. There's so much inventory out there, and because of the high barrier to entry, which we are really, you know, breaking that door down and passing that on to our investors, and we've broken that barrier to entry through our model, you know, to come in at this opportunity. But nobody, you know, there's not a lot of other people that are doing it this way, you know. So it's been able to give us that, you know, that structuring has helped us into the future. And then, you know, really, I kind of want to bring it back to the team of teams mentality that, you know, Octavio spoke to in the very beginning. Look, everybody's got a part of the team, right? Everybody's got has a part to play, right? You don't build a business, you know, you can't build a big business, you know, without having all the right people in the right places. And so the passive investor plays a key pivotal role. They're a member of the team, and that member of the team allows it to, that takes it to the final point. You've got the debt, you've got the passive investor. Well, you had to have the operator, you had to have the vehicle, you had to have somebody put it all together, legal structuring and a business plan. All that has to come together, and it's not all the same people. We're not writing the legal structuring because I'm not a lawyer. We go out and hire the best ones we can find, that understand this in the best way that they can potentially be. That's their role on the team. The passive investor, their role on the team is to bring some liquid capital so that we can make it happen. And that's why we structure it this way. We come from a military background, work in small teams, small dynamic pieces, and we brought that to the table. Octavio, you want to expound on that a little bit?
Yeah. So Danny, I think that was covered macro, right? We do a good job at, like, you cover the macro, I cover the micro, right? It tends to happen a lot, right? So from a micro standpoint, what are some of the clear advantages, right, from an individual? I would tell you, regardless of the organization, whether there's Tempest 22 or any other private equity firm, what do they bring to the individual? I think number one, it's the mentality, right? Is that it lines up with some of that mentality of, I know I want to go either active or passive income. Well, private equity firms help fulfill that passive income requirement, right? And helping achieve that need, which is, I want my immediate need, or my need is achieving some kind of wealth or financial goal, whether it's financial freedom, financial independence, or generational wealth. So again, private equity firms, probably number one is, we already know the investor is coming to these organizations because they have already changed their mentality to change their financial future. And then we fulfill that need, right? Whatever that financial goal is. Now, the other advantage from an individual perspective is understanding that now it's about, now that we've talked about the need, let's talk about the other M, right? From mentality to money. Okay, now that you're creating wealth for me, what does that look like? Do I, like, how much of that is involvement, right? And it becomes very evident and clear to them that, we've, aside from the barrier entry, we've also made it or structured these deals where it's for everyone. As Danny said, we become extremely relatable. Most of these private equity firms are extremely relatable. We all come from different social backgrounds, right? In fact, all three veterans, I can say this comfortably, we all grew up from a poor social background, started from the bottom, and made something of ourselves, right? And it started with the first step, right, which was the mentality, and now we understood financial literacy, right? So, and that leads into exactly what I wanted to cover. When we're discussing, these relationships with our clients and our investors, we're developing these relationships in a manner that allows us to discuss financial literacy, because we value that more than anything else. And I think anybody in this space of taking care of their clients, taking care of people, you should value that the most, right? Because if they don't even invest with you or your organization, what are you doing to increase their financial literacy? Because no one wants to stay in the rat race forever, right? They want to accumulate wealth for either themselves or their next generation. So again, at an individual level, there's a lot of advantages with going with private equity firms. And then, we could talk about performance all day as it compares to the last several decades to stock market or REITs or anything else.
Well, yeah, I think that's kind of a good way to kind of bring things in for a landing of saying, with this asset class, how does it, at least on a 30,000 foot view, compare to some of the other stuff out there? Because at the end of the day, it's always good for people people always want to hear that they're going to make money, but at least in general terms, you can kind of, and that's always a bit of a problem too with looking at private equities. You have large stock index trackers for publicly traded securities going, okay, the S&P 500, the Dow, the NASDAQ did X, Y, or Z. But in general, what have been kind of some of the growth trajectories that have been seen from doing hotels versus commercial real estate versus other types of things in this private equity class?
Yeah, I think Danny, if you want to cover, like, when people ask us, what do they ask us all the time? What's the cap rate, right? And then we explain, how that's different to hospitality management, right? Cap rate versus hospitality management, what we see. And then what are some of those notable financial differences? So Danny, if you may.
Yeah, absolutely. So, what you typically see, I mean, especially, when you go through, learning how to underwrite and learning how to value an investment, as far as like, to get to that cap rate, right? Like multifamily specifically, you have to have that cap rate because as a real estate agent, as a realtor, with a realtor background, in residential real estate, you've got to be able to identify, you've got to learn how, you have to know how to price, how to value a certain, an asset, right? And so with that cap rate, in residential real estate, it's all about, the other comparable sales, right? And so in multifamily, it's the same thing. It's other comparable sales, but how do we, we can't necessarily take it from, multifamily that's sold in Miami versus one that's sold in Tampa, versus one that's sold in, Dade City, right? But what we find is that a common factor across the board that allows us to understand that market is the cap rate. Well, in hotels, the cap rate it's inconsistent across the spectrum. You may find a cap rate of 14%, somewhere, or you may find a cap rate of 3% somewhere, and both of them are equally as profitable, on the long scale. But what you find is it goes off the gross revenue multiple, or a GRM. So in a hotel, and that can be, that multiple can change, right, depending on the market and the condition, right? So everything that we're doing, we're buying them sub 3 GRM. So it, at its current performance. So if it's making $1 million gross revenue over the year, that would, typically, on a something that needs some improvement, you're looking around a 3 times GRM. So that'd be about a $3 million asset. Well, we're negotiating that down to probably 2.4, somewhere between 1.8 and 2.4, right? To get it to, so we're buying it very well. But then, as you improve it, over time, so, our model is to take it, identify it, get, buy it in an advantageous position to where it's got solid cash flow from the beginning. We bring our improvement in to where it's operating at a peak performance. That's typically around a 4. If you sell it right there, it's going to be somewhere between 3.5 and a 4.5, right there. And then the stabilization period, the longer the stabilization period, the higher the GRM goes up. And the reason that is because, so a lot of these publicly traded REITs, they pay a future value. Public companies, public equity companies pay future value for their assets that are stable. And that's what they want. They want long-term stability. So if we had one that was, 6 years at, stable at its peak performance, and it hasn't dropped or dipped, because it's being managed effectively, that's very appealing to a REIT, right? Which may pay 6 GRM. So that $2 million asset that we bought, just by improving it and holding it for a duration, could potentially sell it at the, at that same performance level, at a 6 million, because of the GRM. If that makes sense.
So would you say that, and that kind of brings up an interesting thing of talking about cap rates and GRM, because one of the big issues right now with, at least let's just say, apartment buildings, is the big squeeze and compression of cap rates comparatively to interest rates going up, because you have a relatively fixed income model with everyone signing year-long leases. People aren't coming into hotels signing a year-long lease. They're coming in to stay for 3 or 4 days and getting the heck out. Do you see that as kind of an advantage, or are there other things that you need to look at while saying, okay, here's what my potential cap rate is compared to, what is my underwriting on it, everything else? You do have the ability to kind of adjust your cash flow to a certain extent, but you also have extenuating risk of saying, okay, well, if the economy tanks again, then people aren't going to be traveling as much X, Y, or Z. But is it something that is an advantage or disadvantage, or relatively as agnostic to kind of, kind of trying to protect that cap rate for your investors of saying, okay, well, we have the ability to adjust cash flow almost on a day-to-day basis to meet market demand and market capacity, as opposed to what you have in, commercial multifamily, which is really hitting people hard. That's the big, talk. When I talk to any commercial real estate and people, it's like, yeah, our cap rates are getting put into a vice right now.
Yeah. Alex, I got to tell you, you nailed it, right? Anybody listening in, right? The huge advantage of revenue management that we're able to do it daily, right? And we're able to, catch some of that data. And it's funny that you say that, because that leads into like what's another advantage that individuals trying to understand this industry get, as as understanding revenue management and understanding hospitality. There's a thing called a star report, right? This is unlike the multifamily space, right? That's like benchmarking data. And by the way, it gives you like competitive, if I'm not mistaken, like gives you like, it evaluates hotels based off performance. And but the part that I'm not, if I'm not mistaken, Danny, let me know. I think it does it like every 2 weeks, right? Our hotelier focuses on monthly and provides us updates, right? But that star report, it's extremely effective at providing benchmarking data of how the hotel's performance and how we need to adjust in comparison to our competitors. So we can literally see across the spectrum. That's interesting, but you couldn't get that same type of report in the multifamily space, right? When we own multiple, large commercial real estate, if I go to ask my benchmarking data, that's like going to my competitor and be like, hey, you mind opening up the books? It just doesn't exist, like the reality is it doesn't. So you have no idea if the 4, 6, or 8 cap is profitable, right? As opposed to, in the hotelier space, here's what you got. You got a star report that's easily accessible to anyone on how this hotel is performing as an individual hotel and then against its competition. Yeah.
Yeah, I think that's a really good point that you bring up. There's a lot more there's a lot more information accessible to the investor in this space. Granted, I think kind of the one thing they brought back to is there's a big barrier to entry. I mean, I think is it reasonable to say that the capital, like the upfront capital, is probably not too terribly much. It's probably higher for a hotel, but it's not probably like too much crazier than buying a large apartment complex. Is that relatively accurate?
I would say, in a lot of cases, buying a hotel has been cheaper.
Okay. Yeah. But the big barrier to entry is that management component, right? Because it's so diametrically 100%. Different than just saying, okay, I have an apartment manager that knows, okay, I got a couple storage unit full of toilets that, can all get plugged in there. People aren't, complaining that their ice maker's not working. Like there's a lot of different things that go into hotel management, housekeeping. You don't have a housekeeper in a you don't have a whole housekeeping departments in a multifamily apartment. So I think that's kind of, at least from my perspective, what the whole thing that's, getting kind of Greek to a lot of people is that management aspect, which is why you kind of structure things the way you do with your strategic partner and coming in and saying, okay, we come in on the capital investment side, and then we have to have a, rock star manager to make this whole thing work. Because without that management component, I think we've all said it, crappy hotels, it's all polished and pretty on the front of it, but it really doesn't meet the sub test. It's interesting. I was really looking forward to having this conversation with y'all because as long as I've been kind of tertiarily involved in hotels, I really didn't know much about the investment side of things.
And you know what, Alex, to look at a perspective from that experience or that entry that we keep talking about, the blueprint on the multifamily, most people probably already know this listening in, right? And again, we're not opposed to it. Like when it becomes favorable and we watch the trends, we watch the market, we'll jump right back in. There's no question, right? It's what's the best thing for everyone involved and all our investors, right? But when the blueprint on multifamily is you're lining, you're raising capital, your private equity firm structuring all the resources needing to bring down the deal, and part of that asset management is also finding the property manager to be able to run that large multifamily, the 50, 100 plus units, whatever it may be. Interestingly enough, it's like, what's the vetting process there, right? It's like you're just going out there, you're looking for property management companies with great Google reviews, or they come highly recommended to be able to support this kind of endeavor. That's really what you're doing. Well, how is that different in the hospitality management in the industry? Well, it's tremendously different, right? You have, in the blueprint on this side, you have to find a hotelier that could even pass, the checks, right? People will not, like a franchise will not give a hotelier their flag if, first of all, they don't have the experience, and number two, they meet all the requirements. So you want to talk about, going under, scrutiny or being, investigated with a fine-tooth comb. That's what, these franchises and these flags do to our hoteliers, right? Every hotel operator, you want a Clarion, for example, here's your checklist of what we require out of you. oh, and here's the checklist that we require to, operate and maintain this property at the level that we want, right? This is very unlike, the multifamily. It's, hey, property manager, I think you're the right fit. Thank you for joining. And then the individual checks are on the asset management. It's on an organization like Tempest 22 to say, hey, here are, service level agreements and, requirements, et cetera. But it's not, it's not even outsourced. This portion, it's outsourced and it's demanded by the hotel industry, so very interesting.
Yeah, I kind of want to piggyback on that to really caveat this point home is that in the apartment, in the multifamily space, right, your asset qualifies with the bank, right? Mm-hmm. Your asset qualifies. So in hospitality space, your plan is what qualifies, right? And the plan has to have the right people in place. So, the franchise is not going to give you an approval if the plan, with the right people in place qualify, right? And then again, the bank, if the bank's not satisfied with the qualification, they're not going to approve it either. In a multifamily or an apartment building or any of these other asset classes, it's on the asset. It's not on the operator.
Yeah, absolutely. I think those are all great points to kind of bring this really thing in for a good landing. I want to thank both of y'all for taking your time to be with us today. It's been incredibly educational on my end. I find anything involving real estate and especially alternative assets extremely interesting. So what I always like to do at the end of this is give my guests an opportunity to, give the contact information out. If people want to learn more about what y'all have going on, or if they're interested in getting involved in investing in hotels, how can they reach out to Tempest 22 and where can they find y'all's information out there?
Yeah, no, Alex, again, we can't thank you enough for this, but I think number one, right, to support those individuals that, really want to learn more about us and kind of verify, and increase that credibility, right? Tempest22.com, simple website, lines up with our organization's title. You could also text info at 619-335-8029. And then, of course, to check us out as an individual level and kind of how we bring value to our organization and to our clients and our investors. We have Instagram handles, and we're constantly updating great content, free content to provide financial literacy to anyone and everyone involved, right? So those Instagram handles are our other partner. It's at Housebender. Danny's is dfrye.ceo, and then mine's at Mota Capital. So again, you can find us on LinkedIn. You can find us on Instagram. We're really easy, really searchable. Then, of course, you could text info. And then the last one that I mentioned at the beginning was, Tempest22.com.
Yeah. Fantastic. Well, again, thank you both for being on with us today. We really enjoyed it. This has been another edition of the Alternative Investing Advantage podcast, and we thank you all for joining with us today.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.